Neeraj Gambhir of Nomura, as well as Rajiv Malik, who now joins in from CLSA. Well, Rajiv, I'm going to start off with you. What do you make of the recent moves that we've seen from the Reserve Bank to protect the rupee? Because it doesn't seem to ease that much pressure on the rupee in the long term as it is hurting growth.
Well, Wednesday was really the first effective day that we saw rupee react to the tighter measures. Recall that last week's measures were, I think, poorly designed and implemented, and hence the impact was rather short-lived. But in any case, I think when you technically raise interest rates, overnight rates by 300 basis points, the currency is bound to react. The critical question really is going to be how long can this liquidity squeeze last, whether RBI will have to tighten further, or when they begin to reverse this, if they begin to reverse this, the rupee is going to, crap out again. So I think these are some of the things that are going to be discussed, and certainly with investors' minds. But this is really a typical orthodox defense of a currency under pressure. The interesting twist is typically, although not always, countries would have strong growth and current account deficit problems, whereas in India's case, it's a different combination of growth already having been crippled, and despite problems on the current account side, both in terms of size and the heavy dependence on volatile financing of capital flows.
Neeraj, the initial movement on the currency the last 2 or 3 days probably points towards the fact that, maybe the measures taken have had the desired impact. The question really is, do you think the RBI stays put with these for the next 2 or 3 months to drive home the point and get the desired impact, or these measures start to taper away earlier than that?
So as far as the timing of these measures is concerned, I think it's a tough question to answer at this point in time as to how long will these last. I think we need to see something, some changes to happen on a durable basis for you to say that the currency is, yes, indeed stabilized, and we have seen some change in the expectations from the market. Certainly, I don't expect these measures to go away in the next few weeks' time. I think it could easily be another 2 to 3 months. And the real question would be that if, US dollar starts strengthening against the emerging market, currencies, would we see further pressure on rupee, and will Reserve Bank be forced to add to these measures rather than withdraw them? So I think it's not very clear right now. While the policymakers have been saying that these measures are for the short term and they are to stabilize the market, I think the real objective, how and when it will be achieved and what time frame these measures need to be there in the system is yet to be seen.
So Neeraj, a thought that came in the discussion the last couple of days with other experts was that with the way the bond yields are performed, could there be buying from the FI side in the bond markets local? And conversely, the impact that this has had on the mood on the equity markets, maybe there is an outflow as well. How do you think these two factors affect or negate each other with regards to the currency, the outflows and the inflows respectively, and the impact on the currency?
So, in a classical sense, if you were to raise the interest rates, then obviously the bonds were to become more attractive for the offshore investors, which has indeed happened to a large extent. I think if we see the short-term bonds, the T-bill yields, etc., they've actually gone up quite a lot. But the challenge is that the flows that come to India are not just unhedged flows. To a large extent, the flows that come into India are also hedged flows, and you have to look at what is the hedging cost. Now, while the bond yields have gone up, the hedging cost has also gone up quite considerably, so which means that the net spread that the foreign investors are getting have not really changed all that much. We need to see these spreads change. We need to see the forward premia come off on account of exporter receiving, and only then we could see a meaningful and substantial hedged flow to come back into the country. We could see some reversal of capital flows now because some of the long-only investors, people who are looking at just adding India as a risk to their portfolio without hedging the currency risk, they would certainly find it interesting. On the question of equity flows, I think it's fairly sort of linked to how long these measures will stay and what is the long-term impact on the growth. I personally feel that while the short-term increase in the interest rates is designed to attract, fresh flows on the fixed income side, eventually you need to adjust the current account, and whether you adjust the current account through currency or you adjust the current account through sustained higher interest rates in the economy, that's a choice that policymakers have to make. Of late, I think they have made a choice of higher interest rates, so which means that we would see an impact on the growth, and hence concerns around equity flows, hence concerns around whether we could see some reversal on that front.
Rajiv, what about your views on where you see the rupee headed by the year end? Do you think we could see levels of 65? And what would that mean for the India macro fundamental? And do you think that there's a risk of an India sovereign downgrade then?
Well, the end 2014 forecast for the rupee does not change. That still remains at 65 to the dollar. In the very near term, and this again has been our view, rupee can gain some mojo to go up to possibly even 58. The critical question is going to be, is RBI, given the at least implied line in the sand at 60, is it going to do whatever it takes to defend it? Or at some point it's going to give in and let the currency slide. Quite frankly, given how we think global macro is going to develop, especially in terms of capital flow rebalancing, it'll be exceptionally difficult for RBI on a 6 to 12 month basis to hold that line in the sand at 60, while RBI has categorically not stated that as a line in the sand. And, up until recently, one of the right things that it was doing was not to be wedded to any particular level. 60 now seems to be becoming sacrosanct with India's policymakers.